Very good morning, guys. Warm welcome to the best lectures of FM, SM, and Audit nationwide. Warm welcome. Is the audio clear, video clear, voice clear? Please let me know. Have you all good? Have you all good? Quickly tell me. Quickly tell me. Quickly tell me. Tell me, Meri Jaan. If you are all good, do a like button so we know that everything is perfect. Okay? Yes, sir. All good. Start. Friends, yesterday we discussed to the world of financial management. We discussed that basically after studying FM, what will you become? You will become a CFO. Okay, and CFO basically has three works: procurement of fund, utilization of fund, performance evaluation. Inside procurement of funds, we had how many chapter, guys? Three. Okay, one, two, three. Tell me, what are the three chapters? Types of financing, capital structure, cost of capital. One more time. Types of financing, capital structure, cost of capital. One last time. Types of financing, capital structure, cost of capital. Come to the second, utilization of funds. After procurement, it's time for utilization of funds. Okay. In utilization, we learn two things. Okay. We use the funds for two purposes, either short term or long term. In short term, two topics were there. We either use it for dividend decision or working capital. And second, long term was capital budgeting. If you remember, capital budgeting. Okay. Performance evaluation means you compare the performance of your firm with other peer companies. Okay. You compare with yourself, which is known as inter firm. Okay. Sorry, inter means others, intra firm. Okay. There we also some ratio analysis is there. With the help of that, we try to find out whether to invest in a company. Management will also find out whether they are improving or not. So this is the brief thing we learned. Okay. Today we are going to start a brilliant chapter. Nothing, we are going to learn hardcore concepts. Come to chapter number 6, leverage. Is everyone there? Just give a thumbs up. Okay, it means we are good to go. Everything is good. Okay, we are starting a beautiful chapter. The name of the chapter is leverage. Okay, if you are ready, we will start. Super ready? You have to reply little faster or else we will get late. Super ready? Ready? Okay, chalo. Let us start, guys, right away. What do you mean by the word leverage? Okay, see, this to the concept. Always remember, first few lectures will be very important. Whenever we start any chapter, the first day of any chapter is very important. Why, sir? Because once concepts are clear, there is no power on earth that can stop you from attempting any question you want in the world. So what's the most important thing is concept. Okay, and today for 1 hour or maybe 40 minutes, I don't know how much time does it take, we will only discuss concept. Okay, so let's start right away, guys. Get ready. Okay, leverage. But before starting leverage, what's the main aim of any company? The aim of any company is to increase the wealth of equity shareholder. Okay, the main aim of any company in this world is to increase the wealth of equity shareholder. Ultimately, if dash is successful, everything is good. And who is that dash? That dash is equity shareholder. Always a company works for increasing EPS, VPS, okay, but main aim is to increase the wealth of equity shareholder. Now you will say how the wealth of equity shareholder will increase when the share price will increase. Okay, so what's the total worth of company? Yesterday I told you number of shares into price per share. So if price will increase, okay, automatic things will be good. Okay, now tell me, I want to ask, how will price increase? By taking more risk or less risk? Okay, how will the price of share increase? Of course, we have to take more risk in life, only then the price will be more. Okay, so if we take more risk, the return will be more. Okay, but to maximize the wealth of shareholder, we need to take lot of risk. There are three basic risks in the business. Okay, there are three types of risk: business risk, okay, financial risk, combined risk. Let me name all three. Listen very nicely. Huh? Everything is in a story form. You should understand. What do you mean by business risk? It is a risk associated with firm earning EBIT. Now you will ask me, what do you mean by the word EBIT? Very good. Let me show you. See, first of all, what is there? Sales is there. Yes or no? Yes, sir. In sales, if we deduct what? In sales, if we deduct what? Tell me. Variable cost. What is there? Contribution. From contribution, this is income statement. I hope you know, right? Income statement. Okay. If I deduct from contribution, fixed cost. In English, I call it earning before interest and tax, or EBIT. Okay. So what is business risk? How much uncertainty is there with this figure? Okay. With how much certainty can I earn EBIT? That's the problem in life. Okay. Now tell me, why is it uncertain to earn earning before interest and tax? Due to fixed cost. Always remember, there are fixed costs in the business, due to which there is a high doubt whether I can recover my EBIT or not. Will I be able to do break even or not? Will I be able to earn more than fixed cost or not? So what do you mean by business risk? It is the risk associated with firm earning EBIT. Okay, so for whichever company fixed cost is more. Now you will ask me, what is fixed cost? It is rent, it is depreciation, it is salary which you have to pay at any cost. Are you clear? Overheads are there certain. So you need to realize it is uncertainty associated with EBIT. With how much certainty can firm on EBIT? Why does this come? It comes due to fixed operational cost. Okay, so that's the first risk, business risk. Let me read if you are not clear. 1, 2, 3, start. It is risk associated with firm's operation. Uncertainty about EBIT. With how much surety can you predict earning before interest and tax? Why does it come? Due to fixed cost, rent, depreciation, salary, office expense. Come to second point now, financial risk. Okay, it is a risk due to debt in firm's operation. Whenever you use debt, the risk is always high. It is a risk due to debt in the firm's operation. Whenever we use debt, okay, risk is high. Additional risk is company uses more debt as compared to equity. Whenever I use more debt, the risk is relatively more. Why? Because for debt, I need to pay fixed cost. See here. It is basically risk associated with EBT. Now, from EBIT, earning before interest and tax, what will I deduct? Less interest. So what do I get? EBT, earning before tax. So with how much surety can I earn EBT? Okay, sir, you can earn very good. If EBIT good, then EBT good. No. Okay, it is a risk due to debt in the firm's operation. If we are using more debt, our financial cost will be more. Now you will ask me, what is financial cost? I take several type of borrowing in life, like Adani has taken. Okay, number one, bank loan I can take. Loan. Okay. Number two, I will take preference share capital. Number three, I will take debentures. Clear? So if anything I take, tell me, are these all free of cost, or there is some cost associated? Of course, there is some cost. Tell me, on loan I need to pay what? Interest. Sir, on preference share capital you need to pay what? Preference dividend. Sir, on debenture you need to pay what? Interest. So it is basically uncertainty about EBT, or it is a uncertainty that is risk to shareholder if we are using more debt. Okay, so company which has more debt will have more financial risk. Why? Because their financial cost is more, their interest is more. Adani Green is always more expensive because their debt equity ratio is 7:1 as compared to another firm. We are telling which one? Which one? Zerodha. Zerodha has no debt. Let me read in detail. Okay. It is a risk to the shareholder due to fixed financial cost like debt. Additional risk if company uses more debt as compared to equity. More debt as compared to equity. I hope you are clear. Companies which have more debt will have more risk. What do you mean by the combined risk? Okay. It is risk due to fixed operational cost, fixed financial cost, fixed operational cost, fixed financial cost. Are you clear? Due to both fixed costs, the combined risk is also more. Come here now, come here now, come here now. Okay, now till you are clear till here. Okay, what's combined risk? It is the combined risk due to fixed operational cost and fixed financial cost. Let me come here, you will understand even better, even better, even better. Now due to this fixed cost and this fixed cost, when we combine together, it is known as combined risk. Because after that, will I be able to earn profit? Will I be able to earn profit? In English, that is known as combined risk. So there are three risks in the business: business risk, financial risk, combined risk. What is business risk? Uncertainty associated with EBIT, with how much surety can I earn, earning before interest and tax or operating profit. Come to second, what's financial risk? It is risk in the business or risk to shareholder due to use of additional debt as compared to a firm which will use less debt. I hope you are clear. I hope you are clear. I hope you are clear. Okay, any doubt? Any doubt till here? Absolutely clear, spot on. Let's move on. Okay, so basically there are three risks. Tell me which one, which one, which one? Number one, business risk. Number two, financial risk. Number three, combined risk. Again, I am telling you, just need to concentrate for 1 hour. After that, even if you don't listen to me, you will solve all the sums. That's the power of conceptual clarity. Okay, sir, understood. Now let's go ahead. Okay, till you are super clear. Anyone has any doubt? Type Y. If you are clear, type Y. So we go ahead. If you are clear, you have to type Y. So we go ahead. Fast type. We are getting late. Fast type. Clear. Okay. Now tell me how many risks are there? How many risks are there? Three risks are there in business. Let me divide into three parts. Number one, business risk. Number two, financial risk. Number three, combined risk. Now tell me, whenever there are risks, I need to measure the risk. I need to measure the risk. Okay. How should I measure the risk? Okay. By calculating leverage. Leverage is the name of the chapter. By calculating leverage. Let me divide into three parts. To calculate business risk, okay, or how much business risk is there, I will calculate degree of operating leverage. Degree of operating leverage. What do you mean by degree of operating leverage? That I have not taught you. Are you clear? It is also called as doll. Okay. What do you mean by doll? Baby doll में सोने दी. Oh, ये दुनिया पित्तल दी. It's a Hindi song. Forget. What is financial risk? How to measure that? Through DFL. Degree of financial leverage. Also known as DFL. Now come to combined risk. It is a total risk due to fixed operational and fixed financial cost, also known as DCL. Degree of not Kiran, combined leverage. Kiran is not there, combined leverage is there. DCL. Okay. Now we will continue with the formula of this later when we come back to this chart. As of now, ignore. So there are a lot of risk in business. To measure the risk, we have to calculate leverage. That is, for business risk, degree of operating leverage. For financial risk, degree of financial leverage. For total risk or combined risk, degree of combined leverage. Any doubt? Any doubt? No, sir, whatsoever. Now, what do you mean by the word leverage? Leverage means influence or power. The power which one variable has to influence another variable. One independent variable will influence a dependent variable. In English, I call it leverage. Leverage basically means relationship between two or more financial variables in a business firm, or the power or influence with which one variable can influence another. but that is the book meaning. Let me tell you real life meaning of the word leverage. Today you have to listen very nicely. Huh? Yes sir, please tell. Number one, leverage basically means taking debt. Okay, if I take more debt, I will have more leverage. If I take less debt, means less. Now, many people will ask, what is debt? Debt basically means loan. In English, there are two ways you can build your share market portfolio. Are you clear? Two ways. Number one, all should be your own funds, but own funds people will always have little less. So some people do what? Borrow and build a portfolio. In borrowing, what if there is a loss? Always remember, when you borrow at the right time, the risk is little less. Let's take an example. Right now, market already peak. So if you borrow, there could be a chance there is a loss. But sometime market will come during COVID, lowest ever rates. Okay, market at that time there is huge opportunity. You can get loan at 6-7% and invest in the market and earn 30%. Leverage basically means taking debt. Okay, more debt is equal to more borrowing, is equal to more asset, is equal to more risk, is equal to more return. Okay, there are two ways you can grow: no debt or lot of debt. So leverage basically means taking the debt to finance the asset. More leverage, more debt, more risk, more asset, more return. Let's take opposite: less leverage, less risk, less debt. Okay, less assets, less profit. So there are two ways. Either you can grow on your own or take leverage. Leverage basically means loan. I hope you are clear. Come back to our original meaning. Leverage means the power of one variable to influence another. Okay, how much power my one variable has the power to influence another. In simple words, leverage means relationship between two or more variables in a business firm. How are two variables related with each other? In English, I call it leverage. Okay, very, very simple. Let me show you live. Okay, for the first time ever. See here. I will show you few example and you will be shocked when I tell you what's the effect of leverage. Yeah. 1, 2, 3, start. Guys, girls, let's go to screener. Now many people will ask me what the hell is screener. Screener is basically a app where you can analyze company. Okay. Mittal Brothers has built this wonderful, beautiful, mind-blowing app. No ads are there. In a simple way, I can analyze all the company. I will take 5 examples and leverage practically will be clear. Till your life you cannot forget this topic. Till the time you live. Let's take first example, Indigo. Indigo is what, sir? Airlines. Okay. You will be shocked when I show you certain things. See here. Come to March 2021. Come to March 2021. 14,000 crore of profit are there. Yes or no? See here, sales is 14,000 crore. Okay, clear, clear. Now directly come TTM. TTM means trailing 12 months. But forget that, not trailing. You have to cut this year. This year, 65,000 crore is the profit. Means how much? Sorry, sales. Sales has increased by how much percent? If you tell me 65 to 40 upon 14,000. Almost sales have become 4.5 times. Okay, so sales have become 4.5, but my operating profit from 2 it has become 15,000. Means sales have increased 4.5 times, but my operating profit has increased 7,500 times. ऐसा क्यों हो गया? Why this thing has happened? Due to fixed cost. Understand, during COVID also, I had to pay salary to air hostess. I had to pay salary to ground staff. I had to pay all the overhead expense. I had to pay airport landing charge. I had to keep lot of girls at airport. I had to keep luggage people. But right now, COVID is removed. Okay. So, everyone is coming to the airport. Sales are increasing, but that salary is the same due to fixed operational cost. That is why whenever my sales increase by X%, leverage tells me that EBIT will not increase by same, but it will increase in much higher proportion here. In English, we call it the effect of leverage. Sir, leverage is risk or return? It is both. It is both. It is both. If you look at from risk perspective, it is risk. Other way, it is also return. Okay, how much can you earn due to your fixed operational cost? Look at what Indigo Airlines has done. From 14,000 their sales became 65,000, but look at their profit, baby. From 2 it became 15,000. Why? Leverage. They made use of their fixed operational cost, which will remain same. Tomorrow if sale is 1 lakh crore also, fixed cost will not increase by that much. I hope you are clear. I hope. If you are not clear, then I cannot show more example. I cannot show more example. Come to second one. Come to second one. Today don't stop me. Let's take EIH. Those of you who don't know, EIH is a group of hotel companies, the Oberoi Hotel. During COVID, no one went to hotel because as soon as you go to hotel, COVID will come. Look at their sales. Look at their sales. Come here. Their sales in roughly March was 500 crore. Tell me how much crore? 500 crore. Now come here, come here, come here. Trailing 2,500 crore means sale have increased by 5. This is not my app. It's a screener app. 5 times. But look at how much profit has increased. From minus 354, it became 827, means 354 to 354. It has gone manifold number of times. Why? Because fixed cost. Waiter cost you have to pay. Okay, depreciation you need to pay. Building will still be occupied. Security guard you need to pay, whether COVID is there or not. But when lot of people come, I am able to use those expenses in a better way. So what's operating leverage? To what extent you can use your fixed operational cost and earn profit? I want to take more example. Guys, third example in the screen is restaurant brand Asia, Burger King. Okay, Burger King. From where you bring this? We have a brilliant research team who keeps on doing all this research. Okay, so thanks to them. See here. See here. Where are you? Where are you? Come here. Oh no, this is quarterly. We are least interested. Seer, 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 seer. What a effect you will see. In March 2021, their sale was 1,000 crore. Right now, their sale is 2,300 crore. Means it has increased by 2.3 times. But profit has not increased by 2.3. It has increased from 25 to 200. 10 times. Sale increased by 2 times, but profit 10 times. Why? Leverage, baby. The power of one variable to influence another. If my sales change by this, my EBIT will change by this. Why? Due to fixed operational cost. Okay. I want to teach more. Let's take Atul Auto. Guys, Atul Auto, yesterday we discussed they make rickshaw. Let's move on to Atul Auto even in a better way. Look at this Atul Auto. Look at this. I want to teach today. No. See here. During COVID, their sale was 300. Their sale was, right now their sale is 517. Not a huge growth, but still double the growth. Let's assume 2 times. But look at their profit. From minus 8, it became 41. It has grown 8 times. Sales 2 times, but profit 8 times. Why? Fixed cost. I hope you are clear. Once you are clear with this, then we will come to derivation of formulas. I just want to take you, leverage is measurement of risk or return in whatever way you look at. If you want to measure risk, it is risk. If you want to look at return, it is return. It simply means, okay, the power of one variable to influence another. Now, I will show you live. We will derive formulas, okay. Once you are clear with formulas, there is no power on earth that can stop you. So we will make income statement. Let's take 2 years. This is base year and this is new year or next year. Okay. Base year is last year and next year is this year. Let's draw full income statement. Okay. Sales. Everything is in crores, so we are not writing. Can we write rupees in crores? Okay. Good. So this year my sales are 10,000 crore. Next year let's double it. Okay. 20,000 crore. Tell me less, what will happen? Variable cost. Tell me how much 30% is good? Yes, sir. So 3000 crore. Here it will be 6000. How are you getting this? Multiply by 3. 2 multiply by 3 is 6. Okay, okay, getting it, sir. What do I get? Contribution. Tell me how much will be contribution? 7000. Here 14,000. Any doubt? No doubt whatsoever, sir. Please go ahead. Now, from contribution, what will I deduct? Fixed cost, it remains same whether it is this year or next year. Like few fixed cost, rent, depreciation, salary, office expense. Fixed cost. Let's assume it is 2000 crore. Clear? Tell me, contribution less fixed cost. What will come? What will come? What will come? EBIT, earning before interest and tax. Okay, if you want, we can write also. EBIT, earning before interest and tax. So 7,000 minus 2,000 crore is how much? 5,000 crore. Come here, it is 13,000 crore. Any doubt? Fixed cost will remain same in both situations. Now let's assume we have taken some debt also. So less interest. How much interest? We have a 10,000 crore debenture. 10% is rate of interest. Let's assume 1,000 crore. So here also 1,000. Okay. This year also we have not repaid. Let's assume. So we get earning before tax, profit before tax, whatever you want to tell. So let's write 4,000 here, 12,000 here. Now I will derive all the formulas and you will understand what do you mean by the word leverage. What's the effect of leverage? I showed you practical example. Now it's time to do the sums. We are not doing the sum, just deriving the formula. Okay, start. What do you mean by leverage? Power of one variable to influence another. If one changes by this much, another will change by how much? Okay, so first, what is leverage? Leverage is equal to percentage change in dependent variable upon percentage change in independent. Means what? If independent will change by this, dependent will change by how much? Let me write percentage change in dependent variable divided by percentage change in independent variable. Fully clear till here? Sir, not that much understood. Okay. EBIT in New Year is little wrong. Okay. Oh, here it will come 11,000. 14,000 is there. Minus 2,000 is 12,000. And here it will come 11,000. Okay, okay. Okay. Instead of next year, we could write New Year also. Okay. Chalo, perfect. No problem. Okay now. Okay, moving on. Percentage change in dependent variable divided by percentage change in independent variable. Okay, now let's calculate this. Okay, the first formula is degree of operating leverage. Degree of operating leverage is equal to percentage change in dependent variable upon percentage change in independent variable. So which one is dependent here? EBIT. EBIT is dependent on what? Sales. So I will just apply this formula. Which one is a dependent variable? EBIT. So I will write here percentage change in EBIT divided by percentage change in sales. Okay, so what is the simple meaning? Sales is independent. If sales will change by this percentage, I want to know EBIT will change by what percentage. That's my degree of operating leverage. That's the amount of risk which is there, or that's the amount of return I can earn. Let me calculate. Now both we will calculate. Percentage change in sales. Tell me, let's calculate how much my sales is changing. Okay, one, from 10,000 my sales has become 20,000. Can anyone tell me how much percentage it has changed? If you don't know, I will guide you how to calculate. Okay, okay, whatever is the change you have to take here, from 10 it has become 20, so I will write here 10,000. Basically it has changed by 10,000. Tell me, on what it has changed by 10,000? It has changed by 10,000, agreed. But on what? 10,000 only. Original was how much? 10, and it changed by another 10 into 100%. Okay. So 10,000 upon 10,000 into 100 is how much? 100%. My sales in change is 100%. Like that also you can calculate. From 10, it became 10. But still I am helping you. Now let me calculate percentage change in EB. IT. Tell me, how much my EBIT has changed? Come here, come here, come here, come here. From 5, it became 12. Means it has changed by 7,000. Yes, sir. So I will write here. Divide by. Divide by. On what it has changed by 7,000? You tell me. On what figure? Okay. It was earlier this much and it changed. 5,000 it has changed by 7. Earlier figure is 5. Earlier figure is 5. So I will write here 5. Let me calculate 7,000 upon 5,000 into 100. So 140% it has changed. Understood this much? Understood this much? Any doubt or no doubt? Any doubt or no doubt? Absolutely clear. Okay. So my it has changed by 7,000 on how much 7? On 5,000. So now I will calculate what? Degree of operating leverage. Come here. Come here. Percentage change in EBIT is how much? 140 upon 100. Answer is 1.4 times, or you can also write 1.4 is to 1. But answer is not at all important. What is the meaning of this is very important. It means whenever my sales will change by 100, my EBIT will not change by 100. It will change by 140%. Why? Due to fixed cost that remains same at all level of sales. Means I can take advantage of fixed operational cost and my returns will keep on increasing. That's the power of operating leverage which EIH Hotel has shown. Atul Auto has shown. This brand Asia company, which is also known as Burger King, has shown. They have shown that if sales increase by dash, EBIT will not increase by dash, it will increase by much more because fixed cost will remain same. Sir, then this is to return. How it is risk? See, take opposite. By mistake, again COVID will come. If sales will decrease by 100, then my EBIT will not decrease by 100. It will decrease by 140%. So that's the risk I am taking in life. If you think from positive perspective, leverage is a return. If you think from risk perspective, leverage is getting down. I hope you are understanding. Now, this is a very big formula. Many people are saying, I am not able to cope up. Very big formula, but very logical. See, percentage change in dependent upon percentage change in independent. What is independent? Sale. Percentage change in sale upon percentage change in EBIT. Means if my sale change by this much, my EBIT will change by how much? Any doubt? No doubt whatsoever. We are going little ahead. Now, let me take another formula for this only. Operating leverage. Second formula for this is contribution upon EBIT. But for this you have to take base year figure only. Base year is last year figure only. The one with which we are comparing, you have to take base year only. Okay. For doing this, you have to take base year. Sir, why such a formula? Very simple. Contribution divide by contribution minus fixed cost. Basically, we want to find out impact of fixed cost. Tell me yes or no. Basically, we want to know with the help of fixed cost, I am able to get more returns or not. I want to find out that. So what I did, in numerator, I took contribution and minus fixed cost. I want effect of that. I took EBIT. So simple. Let me calculate, is the answer coming same. So 7,000 upon 5,000 basically. If you understood, let me do it here. Let me do 7,000 upon 5,000, 1.4 times. Or if you don't want this, you can also write 1.4 is to 1. We can also write like this, 1.4 is to 1. Okay, so 1.4 times means what? By mistake, if my sales increase by 100% or 50%, my EBIT will not increase. By this, it will increase. See, this is another formula. Every time we cannot apply the big formula. So we have a small formula. Contribution upon EBIT. How this formula came? Difference is fixed cost only. Answer is coming same. See, 1.4, 1.4. Yeah. Ayla, see? How you got? How you got? It's another way of presentation. Meaning is the same, baby. I hope you understood. It tells us that if my sale will increase by 100% or my sale will decrease by 100%, my EBIT will increase or decrease by 140%. Are you super clear? With this, operating leverage is over. If you are fully clear, only then we will go ahead. Fully clear? Reply little fast. Yes or no? Yes or no? Okay. In the meanwhile, your reply comes. I will start with second option. That's degree of financial leverage. Okay. 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 Yes, sir. Is equal to. Formula will remain the same. Percentage change in dependent variable divide by percentage change in independent variable. Meaning, if my independent will change by this, my dependent will change by how much? Always independent will be down because it is not dependent on anyone. If this will change, that will change by how much? Clear. Clear, sir. Clear, sir. Clear, sir. Okay, 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 okay. So now tell me which one is independent here. EBIT will be independent. Percentage change in EBIT. Upon what you will write? Percentage change in EPS or EBT. Okay. So what I have to find? EPS or EBT. Now you will tell me, why did we take EBT? Because it is after interest. I have to see impact of fixed financial cost interest only. So I will take EBT. I can also take EPS when preference dividend is given. If preference dividend is not given, let's assume easy sums first. Preference dividend will come tomorrow. Okay, today it will not come. We will not cover everything today. One situation pending. So I will write percentage change in EBIT divide by percentage change in EBT. Let me find out. Percentage change in EBIT, sir, you have already found out. Here. It is 140%. Correct? Yes. See here. Percentage change in EBIT is 140. Just write there, copy. So I will write here 140%. Now, percentage change in EBT is how much? EBT is how much? From 4,000 it has become 11, so 7,000. Per 7,000 it has increased. On what 7,000? On 4,000. 175%. I am not calculating, hopefully it's correct. 175%. So let me calculate. 1.25 times. What does this mean, sir? If my EBIT will change by 100%, my EBT will not change by 100. It will change by 125%. Why? Due to fixed financial cost which has to be incurred irrespective of anything. It has to be incurred. If my sales is more or sales is less, this will remain same. So if my EBIT will increase by X, my EBT will not increase by X%. It will increase by more. Now let's take shortcut formula for this. This is long cut. Every time I cannot do. Financial leverage is equal to EBIT divided by EBT. Okay, tell me EBIT upon EBT is what? Let me take what is EBIT. What is EBIT? What is, you have to take base year only. 5,000 upon 4,000. Calculate. I lost Sam. Hey, Sam. Hey. How? Oh, sorry. 1.25 times or 1.25 is to 1. I hope you are clear. Okay, it means what? If my EBIT will change by 100%, my EBT will change by 125%. I hope you are clear. That's financial leverage. The difference is what? It's due to fixed financial cost, which is what? Interest. I hope you are clear. Absolutely. So now, without seeing formula, you tell me what's degree of operating leverage? Percentage change in dependent upon percentage change in independent. Which is independent? Sales. Which is dependent? EBIT. Come down. Financial leverage. Okay. What is independent? EBIT. What is dependent? EBT. Very good. Sir, shortcut formula also I know. Can I tell? Yes, please tell. Contribution upon EBIT. Why such a formula? Difference between both is fixed cost. Okay, come down. Financial leverage, what is the formula? EBIT upon EBT. Why such a formula? Difference between both is interest. And that is what we have to measure. Now come DCL, degree of combined leverage. Is equal to, let's make it easy. DCL into DFL. Multiply both and you will get DCL, degree of combined leverage. Okay, or let me first derive the formula. percentage change in dependent variable divide by percentage change in independent variable. Tell me, which one is independent? Combined, both together, same. Which one is dependent on sale? EBT. If you want, I can also bring the same formula by multiplication. Then can you bring? Please show me. Please show me. I will show you. Don't worry. Don't worry. Don't worry. This is which formula? This is which formula? DCL into DFL. I hope you remember. I hope you remember. I hope you remember. Cut both. Oh, same. Ayla, percentage change EBT for same you brought. I understood. Understood. Why the formula like this? Because it has two fixed costs, operational and finance. Both fixed costs are there. Now let me see what's the answer. What's the answer? EBT is changing by 140%, 175%, 175%. And sales is changing by sales here it is given no 100 100 100 100 100 100. So answer is 1.75 times. Now, okay, you can multiply both DCL and DFL. Answer will be same. If next time you don't want to do such big thing, multiply, 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 multiply. 1.4 into 1.25. 1 point. Ayla, same, absolutely same, sir. How are you getting, sir? How? In English, we call it multiplication. What, how? Very easy. Now, some are saying by short formula bring very simple. Yeah, DCL, degree of combined leverage, is equal to. Let's take contribution upon EBT. Why you have taken this formula? Why you have taken this? Because this includes the difference between both fixed operational and fixed finance cost. But I did not understand. No problem. DCL into DFL. Sir, what is DCL? What is DCL? What contribution upon EBIT? Sir, listen, no, listen, what is DFL? EBIT upon EBT. EBIT cut, contribution upon EBT. Same, same. Here also if 1.75 comes, no, I will give you chocolate, sir. Okay, let me check. Let me check. Let me check. 7,000 upon 4,000. Ira, same. Hey, chocolate, Zomato, send me. I hope you are clear. How much ever you want, you can play with this. That's the power of leverage. What do you mean by the word leverage, baby? The power of one variable to influence another. If one variable will increase by this much, it will not increase by. That is why people take lot of debt. They know. Adani knows the power of debt. Adani has studied leverage chapter so nicely. Okay. He knows if I take debt, I will get more assets, more sales. Okay, if my sales will increase by dash, my profit will not increase by dash, it will increase by y. That's the power of leverage. Leverage means the power of one variable to influence another. Percentage change in dependent upon percentage change in independent. If my independent will change by this, my dependent will change by this. What's operating leverage? Percentage change in sale, sorry, percentage change in EBIT upon percentage change in sale. Now let's move on. Financial leverage, percentage change in EBT divided by percentage change in EBIT. What's combined leverage? Percentage change in EBT upon percentage change in sale. Shortcut formula: DCL, DFL, DOL. God or not what I spoke. Operating leverage, contribution upon EBIT. Financial leverage, EBIT upon EBT. Cut EBT. Okay, what do you mean by combined leverage? Contribution. Okay, I don't know what I'm speaking, but I'm speaking. Okay, cut. I also don't know what to cut, what not to cut. Contribution upon EBT. I hope you are clear. I hope you are clear. There are so many people watching, like also not done. Now any sum you do in this world, it will be very easy. Over. My work is over. Now if I don't teach you anything also, I am done. If I don't teach you a single word, I have done my job, baby. It's over. Nothing I need to do. Nothing I need to do. My only one work is there now, relaxation. Therapy I will take. I hope you are clear. I hope you are clear. No reply. What you will do in life, God knows. See, risky firm will take more debt, more leverage. Okay, it is measurement of risk. Okay. Now, why am I studying this chapter? Tell me, leverage is risk or return? Both ways, both ways. Tell me, this so we have taken increasing situation. What if tomorrow some virus comes? It will decrease. So that is why leverage is good also and bad also. Why bad? If tomorrow still COVID comes or some another virus comes, my sales will decrease. My sales will decrease, then my EBIT will not decrease in same, it will decrease even more. That is why leverage, I need to see risk and return, both perspective I need to see. Why do I learn leverage? It helps me in expansion. Okay, because we have already incurred the fixed cost. Second, it helps to understand overall risk due to fixed financial cost, fixed operational cost, and combined fixed cost. Third, it helps in setting prices. See, whenever I set price, I know my fixed cost is this much. I have to recover this at any cost. Okay. If there are no fixed cost, leverage is one. Let me take example. Let me take example. Always remember MCQ can come. What if there are no fixed cost? Come here. Let's assume a clinic. In clinic there is a, let's assume it's my own clinic. Okay, and I have no receptionist also. Clinic is there, I have no receptionist, means no fixed cost. So 7,000 fixed cost 0. Let's assume it's 0 here. So 7,000 upon 7,000 is how much? 1. One means what? No risk. One means no risk. If it is 5 means, risk is too much. If it is 10 means you are risky, multiply by 10. Are you clear? So always remember, it's lower the better as per ICI. But in real life, those who have more leverage will take more risk, will earn more return. Okay, so you have to think whether leverage is good or bad, whether taking debt is good or bad. It all depends upon your appetite. If you are able to absorb the risk, then it is good. If you are not able to absorb, it is bad. Clear? 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 Either type yes or no. Now what we will do, shall we write some theory? Then nothing I have to do for 4 hours. For you also don't have to do anything. I also don't have to do. We both are free. We will time pass, solve a few sums. Okay? Because once concept is clear, there is no power on earth which can stop you. Which is clear now. If you have listened till this much, no, even if you want to try, you cannot fail. Start. Give heading. Give heading of chapter. Leverages. Once you are done with heading, let me know. Done? Start. Main aim of any company. Chapter number 6, leverages. Give heading. Main aim of any company. New book should be there of FM, nice book. Right there. Main aim of any company is increasing the wealth of equity shareholders. Main aim of any company is increasing the wealth of, what did you write? Equity shareholders. Point number 2. Point number 2. Wealth could be increased by taking more risk. Wealth could be increased by taking more risk. Wealth could be increased by taking, what did you write? More risk. Full stop. There are three risks. There are three types of risk. There are three types of risk. Business, financial, combined. Okay, there are three risks. Number 1, right? Business risk. Business risk. It is risk associated with firm's operation. In business risk, what did you write? It is risk associated with firm's operation. That is, it is risk associated with firm's operation. That is, with how much surety can we earn? It is risk associated with, what did you write? Firm's operation. Did you write? That is, with how much surety? That is, with how much surety can we earn? That is, with how much surety can we earn? EBIT. It is risk associated with firm operation. That is, with how much surety can we earn? EBIT. Due to due to due to fixed operational cost. Due to fixed operational cost. Due to fixed operational cost like depreciation, like rent, salary over. Like rent, salary over. Due to fixed operational cost like rent, salary. Second, financial risk. Financial risk. Second is what? Financial risk. It is, second, right? Financial risk. It is additional risk on shareholder. It is additional risk on shareholder due to debt. It is additional risk on shareholder due to debt. DEBT. Due to debt. Due to debt. Comma, because of which we have to pay. Due to debt, because of which we have to pay fixed financial cost. Like, due to which we have to pay fixed financial cost like depreciation. So like interest, preference dividend. Like interest, preference dividend. You can leave one line and write there, more debt is equal to more risk. Right there, more debt is equal to more risk. Come to third, combined risk. Come to third, combined risk. Right there, it is risk due to. It is risk due to. It is risk due to both fixed operational and fixed financial cost. It is risk due to fixed operational and fixed financial cost. It is risk due to fixed operational and fixed financial cost. That is why it is called as combined risk. That is why it is called as combined risk. That is why it is called as combined risk. That is why it is called as, what did you write? Combined risk. Leave one line. That is why it is known as combined risk. Leave one line. It is risk due to both fixed operational and fixed financial cost. That is why it is known as combined risk. Leave one line. Leave one line. To measure the risk, we calculate. To measure the risk, we calculate. Tell me what? Leverages. To measure the risk, we calculate leverages. To measure the risk, we calculate leverages. Last line right there. After leave one line and write. Leverage is relationship between two or more variables. Leverage is relationship between two or more variables in a business firm. Leverage is relationship between two or more variables in a business firm. Leverage is relationship between two or more variables in a business firm. That is power which one variable has to influence another. That is power which one variable has to influence another. That is power which one variable has to influence. What did you write? Another. Power which one variable has to influence another. Okay. Now you have to nicely write. Okay. 1, 2, 3, start. Give heading 3 types of risk. Like this you can draw. 3 types of risk. Which are 3 types of risk? Tell me. Business risk, financial risk, combined risk. How to measure this? You just have to copy. How to measure this? Through leverages. Okay. Degree of operating leverage. Okay. Here we will write degree of financial leverage. Here we will write degree of combined leverage. Once you are done, let me know. If you are done, let me know. If you are done, let me know. Write D. If you are done, let me know. Chalo, hopefully you are done. Moving on, guys. Now, we will write the basic formula for leverage. In between all you can write percentage change in dependent variable divide by percentage change in independent variable. Percentage change in dependent variable upon percentage change in independent variable. Okay. Now, for all we will write formula. Now we will not write full form. We already wrote. Baby doll, मैं सोने दी doll. You have to write on your own. Try at least. If you are not able to write, no problem, try. Okay. What is operating leverage? If sales change by this, EBIT will change by how much? So which one is independent variable? Sales. Which is dependent variable? EBIT. Percentage change in sales upon percentage change in EBIT. Any doubt? Any doubt? Any doubt? Any doubt? Any doubt? Independent is sale. Which means dependent? EBIT. Or if you don't like this, we want shortcut formula. Every time we cannot change, 2 years are not given. See, whenever 2 years are not given, you can never use this formula. You can only use if 2 years are given. If only 1 year is given, there is no option. We have to use another formula. Contribution upon EBIT. Now you will tell me why such a formula. Difference between both is fixed operational cost. You have to take impact of that only. Over. Over. Now write next. DFL is equal to same mentality. Percentage change in dependent variable upon independent. Which one is independent here? EBIT. On EBIT, tell me what is dependent? What is dependent? EBT. Clear? Or you can also use another formula if you don't like this. If only 1 year is given, only base year is given, 2 years are not given, then EBIT upon EBT. Earning before interest and tax divided by earning before tax. Simple. Yes, sir. Now DCL is nothing, just combined. DOL into DFL. Sir, I don't like so much. I don't like so much. No problem. Then just write combined formula. Will not multiply both. Okay. Enough. Percentage change in dependent upon independent. Which one is dependent? Percentage change in EBT upon percentage change in sales. EBIT cut. Then what is the formula? Contribution upon EBIT. EBIT upon EBT. EBIT cut. Contribution upon EBT. I hope you are clear. I hope you are clear. Done? Any doubt, anyone? Any doubt? Now we can solve unlimited sums, no tension whatsoever. Take any sum in this world, we can solve now. Except one situation, preference dividend, everything over. With the help of this, what will happen? I will know which forms to invest, which forms not to invest. You can write conclusion, 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 just write conclusion and we are done. More leverage is equal to more debt is equal to more risk. Right opposite. Less leverage is equal to less debt is equal to less risk. Simple. So if I want to measure the risk, I will calculate leverage. Leverage is good or bad, depends. How much can you make use of your fixed cost, okay, variable cost, and this? How much can you make use of it? It all depends on that. If I can make use of it, then it's good. If I cannot make use, then it's bad. Are you clear? Are you clear? Are you clear? Is there some space left near formula? Is there some space left near formula? You can also write here. It means, see, risk we have written. Let's write from return perspective. Just write one line here, near formula. If some space is there near formula, please write. It means how much effectively can firm use. It means, you can write near the formula, it means how much effectively can firm use their fixed operational cost. It means how much effectively firm can use their fixed operational cost. It means how much effectively firm can use their fixed operational cost. Come here. It means DFL right there. It means how effectively firm can use their. It means how effectively firm can use their. It means how effectively firm can use their fixed financial cost. How effectively firm can use their fixed financial cost. Come here. It means how effectively combined leverage right there. It means how effectively firm can use both. It means how effectively firm can use both. How effectively firm can use both fixed operational and financial cost. How effectively firm can use both fixed operational and financial cost. Now it's very time pass. We can start with the sum, as many as you want. We can finish today. If you are ready, type R. Ready, then type R. We will start. How much ever sum you want, we can solve. Nothing to teach now. Entire lecture you will solve the sum and I will solve together. Even if I don't solve, you can solve. Can we start? If you are ready, everyone type ready, then we will start. Everyone type ready. If you want, you can take break 10 seconds. Ready? Yes, sir. Let me see if you are ready. One, two, three, start. Chalo. What is given here? Production level, contribution given, operating leverage given, combined leverage given, tax given, compute earning after tax. Whenever such things are given, always draw income statement first. Let's draw. Let's draw. Come to sums, right there, questions, classwork, page number, chapter 6, page number 6.5. Everyone come here. Let's start. Very, very easy sum. Very, very easy sum. Come here. Question number 1. Okay. I will use black now. Income statement. Okay. Income statement, nothing is there. Particulars, rupees. Particulars, rupees. You can write also of Mega Limited if you want. Plain draw. We don't know, if we don't have any figure also okay. Okay. Just draw it. Okay. Start. Is rupees in crore? No. Just draw full income statement. Start with contribution because they've already given. Sales they have not given. Okay. So I will just write with contribution. If I know the figure, might as well calculate 150 per unit 150, 2500 into 150. 3,75,000. I will also write there. Contribution. Okay. So sales minus variable cost not given. Okay. I am not concerned also. Less fixed cost. I don't know. I will write EBIT full form one time. Earnings before interest and tax. Okay. Less interest. If you write short form also, it's highly okay. Tell me, then what will come? Earning before tax less tax. Tell me what I will write. Earnings after tax or PAT. See, every time you have to do together only. If you do together, what will happen? Even your brain will work. If I will do, then you will copy. Then your brain will never work. So I always want your answer should come first, then mine. Okay. If you are done till here, type Y. Type Y. Everyone done? Simple, easy, very easy. Yes or no? Clear? Hopefully you are done. Now, how do I get everything in 1 second? See, OL is given 6. Combined is 24. So tell me what will FL be? 4. 6 into 4. Okay. With operating leverage, contribution is given. I will get EBIT. With EBIT, I will get financial leverage and EBT. Once I get both, sum is over. Let me write there. Let me write there. Okay. Working notes, if you want, you can write your working notes. Tell me what working notes will be there. Very simple. Financial. Okay. combined leverage is equal to operating leverage into financial leverage. So tell me, this is how much? Combined is how much? You tell me. 24. Operating is how much? 6 into FL. So FL will become how much? 4. Clear? How did I get this? 24 upon 6. Any doubt? No. Now, as soon as I got this 4, I can calculate two figures. Okay, let me calculate operating leverage direct formula. Contribution upon EBIT. Tell me, how much is my operating leverage? Very, very simple. 6. Tell me, how much is my contribution? Get it from above. You only calculated 3,75,000. How much is my EBIT? Very, very simple. Just cross multiply. 60 to 500. 60 to 500. Got it. Once I get EBIT, let me calculate EBT also. So sum is over for me. Sum is over for me. You can write financial leverage. EBIT upon EBT. Tell me, this is 4. So this is 60 to 500 upon EBT. So let me write what is EBT. 60 to 500 upon 4. 15625. Any doubt? Any doubt? Any? Sorry, sorry, sorry. Now okay. Till what time sound did not come? Tell me. Last sound came when? Are you clear till here or no? First of all, did sound come? Sorry, mic battery over. Tell me. Sound came till what last? Last sound came when? Are you clear till here or no? Are you clear till here or no? Are you clear till here? Then type Y. If you are not clear, type no. DFL solving. But you are clear, no? I just substituted the formula. I told you now sound will not come anytime also. You will never stop in life. Okay, but you are clear, no? Are no sound understood? Now you are clear. Okay, do less interest. How much is this? 15625. 46875. Less tax is given. Tax rate they've given. Tax rate they've given. Yes, 30%. 4687.5. 10937.5. Clear? So we got the answer. Finally, you can write your answer is earning after tax is 10937.5. You can also write here. So earning after tax is 10937.5 rupees. Okay, with this we are done. Any doubt? Any doubt in first question? Shall we move to second? We will keep on doing, nothing will be hard. Now not even one penny of hard thing can come. Be rest assured. These are hard sum we will do. Even more easy we will do. Shall we go ahead? If all are done, type Y. All are done, type Y. All are done, type Y. Fast reply. Fast reply. Chalo. Go ahead. Second question. Second, don't stop today. Now don't stop. Don't stop. Any sum in the world we can solve. X is estimated for a new product. Its break even point is 20,000 unit, comma. You can do comma if you want. If the item is sold for 14 per unit and variable cost is 9, means contribution is 5. Calculate degree of operating leverage only they've asked. If sales volume is 25 and sales volume is 30. Okay, so what's the leverage for 25,000 and 30,000? So we need to calculate only till EBIT. What do you mean by the word break even point? That point at which EBIT is 0. Okay, break even point is that point at which EBIT is 0. Then if you tell me financial break even point, it is that point at which EPS is 0, but we are not asked that. Okay, so we will calculate normal. What we will calculate? Okay, with this, if once we calculate with this, we will get fixed cost. Okay, contribution less fixed cost is equal to EBIT, which is 0 for 20,000 unit. Once you get fixed cost, you can calculate for this also and this also. No tension whatsoever. Clear? Clear? Okay. Yes, sir. Write a note first. Question number 2, write a note. Right there. Break even point is that point at which EBIT is 0. Question number 2, once we start, right there. Break even point is that point at which EBIT is 0. Break even point is that point at which EBIT is 0. Break even point is that point at which EBIT is 0. No profit, no loss. Absolutely correct. Such point, no profit, no loss. So at 20,000 unit, it is break even point. They have told. Right there. Right there. Income statement. for 20,000 units. Okay, income statement for 20,000 units. What will you write? Particulars and rupees, nothing else. Okay, just draw sales less variable cost. Tell me what will I get? Contribution less fixed cost. What will I get? EBIT. Tell me, EBIT I know is 0. EBIT I know is 0. Okay. Now I need to just fill in this much. Once I am done, everything over. 1, 2, 3, start. Tell me sales is how much? 20,000 into 14. 2,80,000. Okay. Once we are done with this 280, tell me what is variable cost? 20,000 into 9. How much is it? 1,80,000. Tell me how much is contribution? 1 lakh. Sir, we could have done directly also, but no problem. Initial sums are there. Let's work little hard. So fixed cost by default will be how much? 1 lakh. You can write here balancing figure. Over. Any doubt? Any doubt? No. Now easily, they have not asked operating leverage here. Calculate degree of DOL for 25 and 30,000 units. Very simple. Why did I mute? God knows I muted. When did this happen? Maybe with this Kelsey. When did this happen? I don't know. If not understood, please tell me. God knows how did someone mute it. Okay, fixed cost will remain same. Fixed cost will remain same. Okay, what will I write? EBIT. Maybe by mistake I touched here. Maybe. See, fixed cost will remain same. I have just multiplied number of units. Okay, I can write here particulars as well if you want. Clear? Again, if you want, I will explain number of units, particulars 20,000 and 30,000. In number of units, what we have done? Contribution. Less fixed cost will remain same. EBIT 25,000 and 50,000. Now, what I have to calculate? Baby doll, me sone di. A baby doll, me sone di. Tell me DOL formula. Contribution upon EBIT. Degree of operating leverage is equal to contribution upon EBIT. Tell me, how much is contribution? 125 upon 25. Very simple. So how much times? How much times? 5 times. And come here, how much times? 3 times. Not audible, okay, but do you have any doubt? Then tell. If you have any doubt, then tell. Now not audible is over. If you did not have any, if you have any doubt, you have to reply. If you have no doubt, we'll go ahead. What does this mean? What does this mean? What does this mean? Very, very simple. Contribution upon EBIT. If my sales will increase by 100%, my EBIT will increase by 500%. You're at 30,000 units. If sale will increase by this much percent, my EBIT will increase by 300%. Any doubt? No audio understood, but if you have any doubt, please reply. If you have any doubt, please reply. If you have any doubt, please reply. Oh, why 5 rupees is taken in contribution? They have given this. See here. Very good. Nice down. Ask. See here. 14 rupees is the cost. 14 rupees sale minus variable cost 9. So contribution 5. Understood? Understood, Yuvashri? See, array, this is what? Let's take an example. What is contribution? Sales minus variable cost. Sales minus variable. So sales is how much? 14 and variable cost is 9. So 14 minus 9 is 5. Clear? Clear? Not audible after EBIT. I understood that by mistake someone clicked. I don't know who clicked. Now let's come. If you have any doubt, ask. How did this 5 come? Very, very simple. 14 minus 9. Any doubt? Tell. Clear? If you have any doubt, reply. Yuvashri, are you clear or not clear? Please reply. Anyone has any doubt? Then we will solve again. No problem. Hey, hey, ho, ho, la, la, to, do. Clear? Contribution directly. You could have done full also, no problem. But why to do full? 20,000 into, I could have done 25,000 into 14, 25,000 into 9. But they have not asked. Anyone, any doubt? What does this mean? That is important. Don't just calculate. Okay, what does this mean? This means simple. If my sales increase by 100%, my EBIT will increase by 500. Here 3 means what? Sales increase by 100, EBIT will increase by 3. Clear? Shall we move on to the bigger question? Little bigger question. Okay. If by mistake you will have any doubt, you can write here. Okay. Contribution is equal to, draw this line right there. Contribution per unit is equal to selling price minus variable cost. So selling price is how much? 15. Minus variable cost is how much? No, selling price is 14 minus 9. Those who want to write. Those who don't want to write, okay. Those who don't want to write, okay. One more we will do still on one. Still let's do one more. We will do no one more. More we do, more practice will happen. Anyways, after break also sums are there. Shall we do one more? Reply fast. Shall we do one more? Okay. Little bigger is there, but still we can do. No problem whatsoever. Shall we do one more? Whatever you tell we will do, it is your class. It is your class. Others are not replying means we can do. Start. What we have to do? They have given a balance sheet here. Very good. Fixed assets are given. Current asset is given. Total is given. Equity share capital, reserves, debenture, liability. Debenture is very useful. Why? For calculating interest. For calculating interest. Okay? Okay. Go ahead now. They have also given some additional data. Fixed cost per annum 4 crore. Most important thing is what? Excluding interest. Means this fixed cost does not include interest. If you want, you can write interest also here. Right there. Fixed financial cost we can calculate. Fixed financial cost is how much? Just take debenture. Is it 10 into 15%? So 1.5 crore. If you did not understand, 10 into 15 is 1.5. With this, all data is over. Variable cost is 65%. Some new thing is given. Total asset turnover ratio. This we will learn in ratio chapter, but I will explain the meaning now because it's given. Income tax 30. Calculate EPS, operating leverage, financial leverage, combined leverage. So all things good. Two new things are given in life. One is EPS, another is asset turnover ratio. Okay, let me tell you asset turnover ratio. Then we will draw income statement. Once we draw income statement, everything will be easy. Okay. Yes, it covers more than ICI also being number one class. We have to cover all Vishal. Okay, I think Vishal doesn't know these are number one class of India. Even what is not in ICI we cover. Don't worry, Vishal. Come to 3. Very important in life is this ratio. Okay, asset turnover ratio. Of course we'll learn more about ratios in ratio chapter, but your reference has come, so we should know what's asset turnover. With your assets, how much turnover can you generate, how much sale can you generate? It's sales upon total asset. 2.5 means what? If my assets are 20, I can do sales of 50 with those assets. Why? I will multiply the asset. More turnover ratio is more better. With your assets, how much sale you can do? Example, I have asset of 1 lakh and I can do sale of 1 crore. Then my asset turnover ratio is 100. Turnover upon total assets. With these assets, how much sales you can achieve? Higher the better. Always remember, if I can do more sales from my asset, good or bad? Good. This company is able to do 2.5 a turnover of asset. So whatever asset, multiply by 2.5 is that turnover. What is turnover? Sales. And once you get sales, what will happen? Less variable cost. You will get contribution. After contribution, you already know fixed cost 4. You will get EBIT. After EBIT, you already know what is fixed financial cost. EBT will get game over. After EBT, income tax also you can consider. You will get earning after tax. Okay. So now only one thing is pending. I need to tell you one more ratio. EPS. But that I will tell you after income statement. Okay. Shall we calculate income statement? Yes. But before that, we need to apply asset turnover ratio. Right. Before doing that, just apply asset turnover ratio. Write the formula. Asset turnover ratio is equal to, very simple, turnover upon asset. From this asset, how much turnover can I do? Turnover upon total assets. How much is asset turnover ratio? 2.5 is equal to turnover. I don't know, but I do know total assets. I do know total assets. How much is it? 20. Cross multiply. 50. Clear? So turnover I got 50. Okay. Crores only, of course, everything is in crores. Clear? Now, if you draw income, turnover meaning you understood. Never in life you have to forget what is turnover. Okay. Always remember with my assets how much sales I can get. Always remember more turnover ratio, more good. Let me take one more example. Okay. If industry turnover ratio is 10, and your turnover is 2, means in industry from assets people are able to generate sales 10 times, you are able to generate only 2 times, you are less efficient. I hope you are clear. Okay, now draw income statement. After that all ratio will take 1 minute. Income statement of company name not given, not given, just write income statement. Give to heading particulars rupees. Rupees in crores, right? Okay. Once sales is there, all figures are good. So sales is how much? 50 crore. Less. Variable cost is how much? They have given. I am not calculating. Variable cost is 65% of sales, of course. So 50 into 65%, 32.5. Clear? Sales less variable cost. What I will get? Contribution. Clear? Contribution 50 minus 32.5, 17.5, less fixed operational cost. Tell me, operational cost is how much? Given in the book. Given in the book. Given in the book. Excluding interest. I wanted that only, excluding interest. 4 crore. What do I get? EBIT. 13.5. Less interest I will do. If you want, we can multiply also. 15 into 10%. Sir, can you tell me how this came? How this came? Very simple here. 10 into 15%. So 1.5. Of course, all is in crore. Earning before tax, 12 crore. Any doubt? Any doubt? Any doubt? Any doubt? Okay, continue. Less tax. Tax is given. Tax is given. Tax is given. 30%. 3.6. Profit after tax. 8.4 crore. Any doubt? No, sir. Now, preference dividend is not given. But let's assume was it given. Then what we will do? Less preference. See, this is profit for both equity and preference shareholder. If preference is given, their name only suggests they are given preference first. They are given preference first. They are given preference first. So I'm just writing, though I will write 0. Less preference dividend. Of course, we will write 0. Now, these are earnings after deducting exclusively to equity shareholder. I hope you are clear. 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 Absolutely. Super duper clear. Sir, understood till here. Any doubt, tell me. Any doubt, tell me. Any doubt, tell me. Everyone is done till here. Now, very. One last time. This is for both. 8.4 crore is for both. Less preference not in this sum, but in future it will be there. So earning exclusively to my premium people, equity shareholder. How to calculate EPS? Most important formula. Very easy in 1 second. How much earning per share is there to equity shareholder? Total earning upon total share. Total earning upon total. Reliance Industries Limited, boys and girls. Total earning in Reliance is 100 crore, but there are 50 crore shareholders. So 100 upon 50. Per share 2 rupees earning are there. Same way, total earning in this company is 8.4 crore. But how many are share? I want to find out EPS, earning per share. Earning per share. Earning per share. Okay. So now how many things they have asked? 4. Let's calculate all 4 and we are done. Very nice formula. Logically understand. Earnings per share is equal to earnings to equity shareholder upon number of equity shares. Tell me, total is what? Let's write in crore only. 8.4 crore. So write total. 8 crore 40 lakh. Upon how many equity shares are there? How many equity shares are there? How many equity shares are there? From balance sheet we will know. 50 lakh shares are there. 50 lakh. They have given the number 50 lakh. So write number of shares. Number of shares 50 lakh. Tell me. So EPS is how much? 8 crore 40 lakh upon 50 lakh. 16.8 I am getting as EPS per share. 16.8 per share. 16, of course, it is per share only. So if you don't write, also okay. 16.8 rupees. I hope you understood. Means all 50 lakh shareholder, not shareholder because we can have more than one share also. Every share is able to earn 16.8 rupees. I hope you are clear. Now, to three things you already know what are three things. Okay, over. Contribution upon EBIT. Tell me, how much is contribution? How much is contribution? How much is contribution? 17.5 upon 13.5. One 1.30. It's 1.296. So we can round off. 1.30 times. This is not important. Meaning is important. What is the meaning? If my sales increase by 100%, my EBIT will change by 130% due to fixed operational cost. Calculate financial leverage. EBIT is how much? 13.5. Upon how much is EBT? How much is EBT? 12. 1.125 times. Here we can take full also. Okay. Tell me what is combined leverage? Multiply, multiply, multiply. One 1.46 times. Clear? Hopefully you are done. Now what we will do? Always remember, you need to make the life of examiner easy. Always if you make his life easy, he will make marks for you easy. So we can draw summary. Whenever they've asked so many things. EPS, operating leverage, financial leverage, combined leverage. Okay, just type how much is EPS. 16.8. Operating leverage 1.30. 1.125. Over. Prathamesh, what changes are there? A lot of changes are there, okay, in FM. Number one, MCQs are introduced in FM, so more emphasis on theory. Inventory chapter is deleted in FM, okay. One more, risk in capital budgeting deleted, but theory emphasis more. Conceptual changes are there, okay. Done. Any doubt, guys? Any doubt? If you are done with this sum, now we can take a small break. What say? Everyone done? If you are done, let me know. Type done. Everyone done? When we will return again? Half an hour? See you at 10:30. Bye bye. Good night. Take care. See you at 10:30.